Good day, everyone. It's almost lunchtime in South Africa here in Johannesburg. I am Langa Manale, Head of Equity and Equity Derivatives here at the JSE, responsible for the commercial proposition of the JSE. The JSE Stock Picks series kicked off in August 2021, and we believe that in an ever-changing world of trading, a professional opinion is valuable when picking a stock. So SA Stock Picks is an online stock analysis series brought to you by the JSE. This series aims to take you through on a journey on our markets as we host various independent industry heavyweights to unpack their top stock picks for the week and on why you should, as an investor, consider them in your portfolio. Our analyst will be providing you with a simple investment thesis without market jargon. Stocks that they have previously picked, you may know them. They will be, however, covering new stocks in this time around. We will be focusing really on the main three things. Each analyst will tell you what is the stock that they're picking and giving you the supporting investment thesis or the story, why this specific stock you should consider it, and what is the outlook on that stock pick. So just a brief way of introduction. I have here on the line Simon Brown, who is the founder and director of Just Invest One Lab. I also have on the line Asanda Noche. Asanda joins the team from Mazi Asset Managers. We are also joined by Piet Viljoen, who is a manager at Merchant Works Investment Value Fund. And lastly, we have Keith McLachlan, who is an investment officer at Integral Asset Management. Gentlemen, welcome. Maybe before we just really dive into the story, so that our viewers may get a sense of who you are, just as fellow South Africans, would you please each just share just a brief fact that is interesting about yourselves? I'm happy to start with you, Asanda.
Okay. Good afternoon, everyone. So interestingly, the last time we did, I was on Stock Picks, we had just gotten our first dog. So my wife and I capitulated and we'd gotten a dog. Guess what? We've just gotten another dog because apparently you can't have one because it's a miserable life if it's just the one dog. So yeah, so 2 dogs now. Thanks.
Thanks, Asanda. Hopefully you are enjoying the time with the dogs after work, and maybe you're taking them out for a walk at least. Pierre Viljoen, on your side?
Yeah, I think the short summary is I've been a value investor now for over 30 years in the South African market, and I've got scars to show for it, but it still remains fun and interesting, and there's always new stuff to find out, and hopefully today we can share some of those ideas with you.
Thanks, Pete. We're looking forward to hear about your war stories today. Shall we move on to Simon?
Thanks, Langa. So a lot of folks might know this might be. I bought my first shares in October. It was the 17th of October. It was also 1987. The market collapsed 22% the week after. So all my stock picks always come with healthy warnings.
Thank you for that health warning there, Simon. Last but not least, by any means, Keith, over to you.
Thanks very much, Langa. And Asanda, congrats on the second dog. It's really a wonderful species. We, as human beings, I don't think we deserve dogs. We've got a basset hound that I've tucked off into the background here, so hopefully it doesn't jump on screen. But an interesting thing about me, well, actually, we could see some of the guitars in the background that I play. I've been playing guitar since I was about 13 years old, which is a little bit longer than I've been in the market, but I've been in the market going on 2 decades. Started off in the small and mid-cap space in South Africa, and by virtue of the fact that we've a global village, one has had to expand into large caps and one has had to expand into global, which does provide a very nice context for some of the stock picks that hopefully have value that I'm going to bring today.
Absolutely. Thank you very much, Keith. Gentlemen, thank you very much for indulging our viewers with those interesting facts on your backgrounds. It's good for human connection. Let's take it to the top. So our first person who will go out and on Pierre is Asanda. Asanda, over to you. I will be taking immediately after each analyst has spoken questions directed to that analyst before moving on to the next. Over to you, Asanda.
Okay, no, thank you very much, Langa. Thanks for hosting. So I'll talk about three companies that we think have got positive prospects. First one is Aspen. So look, it is flu season. So I thought it's probably appropriate to have a shot of something there in terms of everything that we're going through. The company's strategy, business model, we think is sustainable because they've got an integrated model. So they've got branded products that you can buy at the pharmacy. They've got a manufacturing capability as well, world-class facilities that they then either manufacture their own products from or manufacture for other people. And also distribution. So you might see at your local doctor, pediatrician, and so on, you've got these Aspen agents coming to talk to the doctors about the products that the company sells. Now, healthcare, I think, as a sector, we think is also offers attractive opportunities for these companies because there's a great deal of advancements in healthcare generally. So if you think about the things that used to kill us, 20, 30 years ago, a lot of those things are now can be treated in one shape, form, or another. And so that then also requires the associated medicines and treatments and so on. The company's strategy also with regards to the manufacturing is quite interesting, where they are expanding their interaction with other players in terms of manufacturing in their own facilities. So that then increases their ability to generate revenue and profits from that. We think also the company's got lower cost of debt in terms of some of the facilities they've been able to secure from multinational lenders. And so that also brings down their cost of debt, increasing the value that they can generate for shareholders. And finally, management has also learned from the past. I think there's a good mix in terms of the owners or the founders rather, in more sort of corporate professional management that's in the business now, which does mean that there's a good sustainable mix as far as the management group. And so combined, all of that for us means that there's the resultant prospects are quite positive and the valuation is attractive in terms of where the company is trading. The next company is Investec, which is the bank, as we all know. So Investec's strategy and the thesis that we have in the company is that they are going to or likely to be able to increase the client numbers that they've got. So as you know, Investec is a private bank for the most part, with a wealth management business as well. But they're now looking to expand the criteria in terms of the professions that they bring in and so on. So they're quite selective, so it's the accountants, it was the doctors, but now they've realized that there's more careers beyond that which are also doing quite well and are lucrative. So IT professionals and so on. So that then opens up a new venture or new opportunities for them. There's also then in the UK the opportunities that they have there, where they've started a private bank and are growing steadily. So that growth we think is going to come through and provide them with sort of steady opportunities. We think also the recent deal that they've done with Rathbones in the UK, where they've taken their wealth management business and merged it with that of Rathbones, gives them greater scope to access the clients, or a greater number of clients from a Rathbones perspective, as well as having a greater geographic sort of spread or geographic reach. Now that they've now got also the Rathbones network as part of what they can access. So we think, again, that provides them with solid organic growth. There's also still some excess capital. I mean, the company is busy buying back its shares as a way of returning excess capital to shareholders. And so we think that's quite attractive as well, and also is supporting the valuation of the company. Finally, coming back and talking about the continent, MTN is another stock where we think the company's got exposure to very high growth markets. So when we talk high growth, it's places where perhaps mobile telephony and so on hasn't been penetrated as much. So that gives them the opportunity to grow and as more subscribers come on. I think the important thing as well with regards to telcos and these telecoms companies is that they're becoming quite important in our daily lives. So some people, in fact, I mean, we're communicating over the airwaves right now, but a lot of us and some in more ways than we're doing now are running their businesses through telephones, mobile and data usage and so on. I mean, in Ghana, for instance, the government at times uses the MTN network to distribute salaries for government employees. So it's really then becoming quite integral as part of life. And so MTN is also evolving its business model, where it's now including things like what they call the mobile money sort of piece, where people can then do transactions, send money, receive money, make payments, and so on through these platforms. That also then gives the company the ability to also start offering products and services through that same platform. So we think that's quite attractive as well, and gives the company a good runway and opportunity. Management-wise, we think the company is also, if you look at the past couple of years, is really focused on getting the right people on the board. Management team is well focused and is executed well. And I think also from a Nigeria perspective, which is often cited as one of the big risk areas, the company has done well to navigate that space, and also the recent elections and the sort of what's coming out of the new president, we think could be a catalyst for resolving some of the challenges in that market. So again, with MTN, we think as it stands now and where it's trading presents a fantastic opportunity. Of course, I think a lot of the shares and companies that we have in the market have reacted in terms of what's happening globally. And so MTN is one of those where we think there's a sustainable business model, good management team, and therefore a decent opportunity from a valuation perspective. Thank you very much.
Yeah, thank you, Asanda, for that very well diversified proposition covering health, financial services, and the telcos. I am just looking over to see if there are any questions coming through. At the moment, I don't seem to be picking any on your side. So I'm happy to hop over to the next speaker whilst hoping that there'll be questions coming through. So we'll circle back to you. Pierre, over to you.
Thank you, Langa. So I'm going to speak today about a few small cap South African deep value situations. And I think it's very important to understand why I want to speak about these type of stocks, deep value, small cap South African stocks. Because when you want to invest in something, you need to understand why something is cheap and if the odds on your side or not. And I always come back to this, the story, if you want to win a game, you can do one of two things. You can either become the best player, which is very hard, or you can pick a game to play where all the other players are quite weak. And that's a much easier proposition. So I'm picking to play the investing game in small cap South Africa where there are no players. Nobody is looking at these companies. Nobody is analyzing these companies. So there are no players, and I think it's a very easy game to win. So the three stocks I want to look at in a particular order were Astoria, Lewis Stores, and I think I mentioned Telkom, but I'm going to cheat a bit. I'm going to replace Telkom with Adcorp. All these companies have a couple of things in common. They're all cash-generating businesses where they're either buying back their own shares or the insiders are buying shares in these companies, or a combination of both. So you don't need somebody from outside to come in and recognize the value. These companies are creating the value for themselves by buying back the shares or where the insiders are buying the shares. So let's start with a growth situation, a company called Astoria, which is an investment holding company, which has become a bit of a swear word in South Africa. But this company, Astoria, to which I'm affiliated, owns 4 or 5 South African businesses. All of them are cash-generating businesses. The biggest one there is a company called Outdoor Investment Holdings, which owns Safari Outdoor, which is an outdoor equipment retailer, and Formalito and Inyati, which are wholesalers in that outdoor equipment industry. It also owns a chain of pet stores called Family Pet Center. It has been growing its earnings by 20% a year for the past 10 years. Sometimes a bit more, sometimes a bit less, but on average around 20%, and we value it in a very low multiple of 6 times. And it's a great business. Those of you who are living in the vicinity of Safari Outdoor Store, go visit one of the shops. The shopping experience is amazing. The second biggest holding in Astoria is a company called Transex, which is a diamond mining business. And as we all know, diamonds are forever. And diamonds are also a girl's best friend. The product it mines is a popular product, and it has been around for a very long time. Transex itself owns an alluvial diamond mine in Angola and has recently expanded into marine diamond mining operations as well. So the business is growing. It's growing by acquisition and organically, and it generates lots of cash in US dollars, which is a very strong proposition. So Astoria is an interesting thing, trading at a big discount to NAV. And for that, you can get a hold of some really interesting South African businesses. The second stock is Lewis Stores, which basically in the home furnishing and retail sector of the market is basically the last man standing. All its competition have either gone bankrupt or are pulling back. It's a tough market, but Lewis has a very good management team, and they are continuing to expand the business. Every year, they're adding 20 to 25 stores on a net basis. So in a sector where everybody else has gone bankrupt or is departing, Lewis is expanding. And they are doing so with internally generated cash. The cash flow is actually quite strong. The cash flow is a lot higher than accounting earnings. Over the past 7 years, they've earned 1.5 billion rand more in cash than the accounting earnings say. And the reason for that is because of IFRS 9, which is an accounting regulation, which says the accountants must put a fair value on your financial assets and liabilities, and they come up with some, backroom formula, and it's just the valuation they put on is just far too low. The debtor controls of Lewis is much better than the accountants had in their model, and therefore the cash they generate is a lot better than accounting earnings, which is determined by accountants doing some funny sum in the background. And Lewis is buying back its shares. It's bought back a third of the company over the past 5 years. They've gone from 90 million shares outstanding to 60 million shares outstanding. So they don't need anybody. They don't need stockbrokers to cover the stock. They don't need asset managers to buy the stock. They are buying back their own business over time through the cash flow they generate. So I think that's another fantastic opportunity. And the third one I want to talk about is Adcorp, another cash-rich business. This business has gone from 1.3 billion in debt to 300 million in net cash over the past 7 years. It has gone through a tough time with changes in labor legislation, which has caused ructions in its business, but it has overcome those as an asset-light business. And it is also buying back its own shares. It's just declared a special dividend of almost R1 a share on a R5 share price. So you're getting 20% back within a month already. And then it's trading below liquidation value. In other words, the cash and the balance sheet is more, after deducting all liabilities, more than the current market cap. Dirt cheap. Like many other stocks out there, but I've highlighted these three because they're all cash-generating businesses trading at big discounts to realizable value. And it's a game where no one else is playing and the odds on your side. Thanks very much.
Yeah, thank you very much for finding those hidden gems and just unpacking the stories and talking about the cash generative capacity of those businesses that you cover. I did note that one of it came with a disclaimer that you are affiliated to it, but thank you very much for covering it dispassionately. Simon, let's move over to you.
Thanks, Langa. I'm going to touch on 3 stocks. I'll have myself a banker. I'll have one that's well timed at this point, and then we can get a speculative one at the same time. My banker is going to be Shoprite. I mean, I've owned this business for about 20 years. I actually sold out of Pick and Pay to pick up Shoprite. And if we look at the other food retailers out there, Pick and Pay have probably had more turnaround strategies in the last 2 decades than many of us have had hot dinners, particularly with Eskom load shedding. Spar has had management issues, a horror trading update yesterday. yesterday, yet Shoprite carries on going. And they carry on picking up market share, and I think that's quite important. They have operating margins which are world-class. Forget best in breed in South Africa. They leave the competition in the shade. They're absolutely on a global standard, an operating margin which any of the Sainsbury's or Walmarts or the others would absolutely love to have. And the key point is, we need to be eating. We even when times are tough, we need to eat. And Shoprite's got that brand recognition. It's got the loyalty of customers. You understand that whether it be a Shoprite or a Checkers, and they're there, they're looking after their customers. They sell loaves of bread for R5, where anywhere else your bread's going to cost you 15 or 20. They do blue collar lunches at under R10, because that's what the blue collar worker can afford. They can't afford the more fancy lunches, and they've managed the challenges of the last year, most notably inflation, but also load shedding. Load shedding is absolutely hurting them. There's no doubt about that. The biggest risk to them perhaps is that ultimately we saw it with the Tiger Brands numbers, where demand is just, as prices are going up, demand starts to evaporate. And is that going to negatively impact Shoprite? To a degree it is, although Tiger Brands has got lesser product range. Of course, Shoprite will have no-name brand product on the shelves and a whole bunch else. But even just looking at the SPAR update yesterday, they had some SAP problems in KwaZulu-Natal, which KZN is full of SPAR stores. And I can't doubt that Shoprite has been picking up some market share in that space as well. It's never going to be a hugely cheap stock. Forward PE is currently maybe 17 or 16 times. It's about as good as it gets. Below 200 Rand, sitting on a dividend yield of a little over 3%, which for Shoprite is chunky. It's usually much higher rated stock in terms of valuation, and specifically in terms of dividends, usually only around 1.5 or so. So Shoprite, the first one, in essence, the banker. The one that's well timed at this point is Reinet. The company founded in 1888, listed in 1940, boring industrial stock that most people just somewhat forget about, never really bothered to look at. In the ICT space, they've got things such as Nashua. ICT's doing okay. It's got some challenges, work from home, taking some of the shine off some of their businesses. Load shedding hurting. I was chatting with the CEO, Alan Dixon, recently, and he says, for example, they've got call solutions, and people aren't making the phone calls for large periods of the day or answering them because, well, load shedding, and therefore simply they can't. But it's still profitable, it's still doing fine, it's still growing. The two areas of real interest which are well positioned now, and let's be clear, the market has picked up on this, the stock has been running. The first is their power cable business. This is both manufacturing as well as maintaining. They've got a lot of IP in that space. They're working to the rest of the continent as well, Tanzania in particular there. And these are these giant overhead cables that we see running power down, although those are usually the 450 kV, which they maintain rather than produce. But one of the things we need in South Africa, Eskom needs, aside from just good old-fashioned make electricity, having made the electricity, they need to move it from A to B. And that's hugely in the space where Reunert is operating. And then the third space they've got is their defense and renewable. The defense is not so much bombs and stuff, and it's not the benefit from what's happening in Ukraine right now. They've got some old ANSYS businesses in there. ANSYS became, was it Ethan, before essentially breaking up and selling all the parts. That's doing fairly well. A lot of that is going to be US dollar-based earnings, because that's where the defense industry is operating in US dollars. And then, of course, renewable. And renewable, we all get that story. The numbers are staggering in terms of, just compared to where we were last year in terms of renewable energy coming onto the grid. First 3 months, 4 months of this year, we're already matching the entire of last year. And that the load shedding tends to do that. And it's not just businesses, it's individuals as well, it's communities. Renewable is leaping forward and going to continue. And at some point, the load shedding ends, but the renewables are there. The boom will fade away. It'll be more around maintenance and replacement. But right now, there is a huge move to add literally thousands and thousands of gigawatts of power onto the grid via renewable, because of independence from Eskom, but also because you can get it up fairly quickly. For a home person, you can, depending on demand, you can probably within a couple of weeks get panels on your roof, a battery in your garage, and you are off to the races. And then my third stock is my speculative one. Always a bit of speculative. I've held the stock in the past. I've sold it and held it and sold it. And it's Calgro M3. They build housing. And the one thing which South Africa might need as much as electricity is housing. We have chronic housing shortages. You can drive anywhere in this country and you can see the problems with a lack of housing. And that's where Calgro operates. They had truthfully, a near-death experience about 3 or 4 years ago. I wasn't sure. In fact, many weren't sure that they would manage to survive and come through it. And they absolutely have. Last set of results showed earnings a share of little over R1.50. The stock's currently trading at a little over R3. In other words, it's a price earnings of 2. Of course, you've got to get the interest in the folks there as well. They've got memorial parks. What they plan with memorial parks is that in time, that will cover their annual cost. And then the construction side, the housing side, units as they call them, will then sort of be the profit and the cream on top. They have flexibility in housing in that they can move where they're going to be. Are they doing the plus 3 million rand houses? Are they going down for the much cheaper sort of government subsidies type of houses? And they've done a lot of crafty things in terms of where they put the stairs and corridors and stuff. They talk around up to 20% of a building just being dead space, just stairways and corridors and that sort of thing. And they're able to claw some of that back, give it half of it to the person buying the apartment, but also save on costs in their regard. Risks, obviously, inflation. Risks, obviously, the consumer under pressure. Although notwithstanding, we are seeing home prices up, trending below inflation, but nominal home prices up around 2%. And maybe, more than anything, Calgro at only a 2 PE, perhaps is actually a takeover target as much as anything else. Langa, appreciate the time. Back to you.
Thank you very much, Simon. I like your bravery. It seems like even in the dark cloud, you're finding the silver lining and some load shedding busting peaks. So thank you very much. Gentlemen, the questions are beginning to trickle in, but I think just not to disturb the flow, I will continue and then I will just, once Keith has wrapped up, then we will fill the questions. Keith, over to you.
Super. Thanks very much, Langa. And having the privilege of going last, I get to throw in my opinions on the other picks. So Asanda, big fan of Investec, valued like a South African bank, but 40% of the earnings outside of South Africa and hard currency in the UK. Great pick. Pete, Astoria, deeply discounted to a quickly growing NAV, and its NAV itself is conservatively valued. That's a great pick as well. And Calgro M3, Simon, I think just the sheer land value that the group is carrying at historic cost on its balance sheet, if one were to fair value it, the rest of the business is likely to be free. But I've taken it in a different direction. I'll come with three different stocks. My first one is Santova Logistics. They are a global 4PL logistics player. To understand really the value of this group, let me give you some numbers. They've got a long growth track record, and there's, I believe, plenty more to come. If you look back in the last 10 years, so it's a decade, Santova's grown their revenue at 14% year on year, and that is created with operating leverage. They have grown their headline earnings per share by 24% year on year, every year for a decade. Just to put this in context, one of the market darlings is Capitec, one of the longest running growth stories on the JSE that hasn't fallen over. And Capitec's 10-year average headline earnings per share growth is only 19% year on year. So Santova is growing faster. It is, in fact, in a larger market being global logistics, and about 3/4 of that market, 3/4 of its earnings come from outside of South Africa. They've just ventured into America. That's likely, if they get that very small beachhead into America right, they can scale it very large, and that's likely to be the next decade or two of growth engine driving Santova. And all of this, if we take this and we look at it, it's on a stock on about a 5-6 times multiple. If we take that stock and double it, its valuation is still at a 10% discount to its global peers. There's a stock really like. It's got it's proven a lot of growth. It's got a long runway of growth. The next one is Momentum Metropolitan, one of the major life insurance players in South Africa. Their embedded value is 32 Rand per share. The current share price is about 16, 17 Rand per share. That's about a 50% discount to embedded value. Now, is that high? Is that low? Well, the starting point is life insurers are, in fact, in the rebound. We've come out of the pandemic. Momentum Metropolitan earlier this week, last week, had an operational update where they are seeing excess mortalities normalized to pre-pandemic levels. Life insurance industry is having a resurgence because of these large whacks that they had during the pandemics and lockdowns coming out the system as they're repricing the risk premium. And at the same time, they get the endowment effect. What is the endowment effect? Well, they've got large amounts of regulatory capital on their balance sheet that sits there and does nothing. They just have to hold it. It does actually earn interest. And as interest rates go up, like they have materially now, that's free returns. They leverage and fall down to the bottom line. And so the industry is in a good place and it's coming out of a bad place. Why is Momentum Metropolitan at nearly a 50% discount? Well, if you look at peers, Discovery trades in line with embedded value. Sanlam's at about a 15% discount. There is no reason they should be trading at a 50% discount. Their history, in fact, indicates on average they should be trading on about a 19, 20% discount. So there's a free 30% here. And in fact, embedded value is growing. Endowment effect is helping. And they're coming out of the back end of the pandemic. All of this with a 6% dividend yield. So one can take your time, earn a juicy return while you wait for it to re-rate. Momentum Metropolitan, really, really great investment. The next one is possibly a bit controversial. I'm expecting to get a little bit of hate mail and angry questions about this, but Transaction Capital. Was Transaction Capital offering significant upside at this point? Well, first of all, everyone is aware of SA Taxi and the problems there. Write it to zero. Give it no value, does not even have that argument. The debt is ring-fenced into that structure. Management has repeatedly communicated this. They're currently negotiating a 500 million Rand bullet payment to roll over. If that does not happen, SA Taxi, they're willing to walk away from it. Write it to zero, that's free upside. That leaves two major parts of the business. That's Newton and We Buy Cars. Newton, built out of a top-tier domestic debt collection agency that figured out and really pioneered the book buying part of that business, that then progressively went offshore into customer experience management and has been hugely successful in this. 40% of their turnover comes from offshore now in the customer experience segment outside of South Africa in hard currency. South Africa has structural advantages in servicing this part of the market. Not just are we in the correct time zones for Europe, UK, we also have English as a first language, or at least a dominant language, and we have a cost-based structural advantage. We're a cheap country to operate from, earning hard currency and paying a cost base and soft currency. Newton, if we look around the world and we find their global peers, we then still give them a 33% discount against that. Newton alone is worth around about 8 Rand a share. Transaction Capital is trading at about 7. Then we have We Buy Cars. Not going to get too involved there, but we think that there is a value here, 8 to 10 Rand sitting in it, depending on how you slice the multiple, how you see normal earnings coming out, and how much market share you see them ultimately winning. All of this is still giving SA Taxi zero. We're writing TC Ventures to zero, and we see assuming no other growth in anything else, and applying some liberal discounts into it. Now, if we add those two, We Buy Cars and Newton together, you're looking at a fair value of, let's call it about 18 Rand per share. Transaction Capital at 7. There's just multiples of upside here. When market darlings fall out of bed, sentiment turns so sour that there are often opportunities there if you think that they can come out the other side. Yeah, this will probably take 3 or 4 sets of results to prove this wrong, but we do believe that management kitchen sinked and wrote off aggressively everything in the current set of results. So you're likely to surprise to the upside in the next series of results. We, once again, are giving SA Taxi zero value, it is unlikely to have zero value. We think that management will see that through. And hence, my 3 picks, Santova, Momentum Metropolitan, and Transaction Capital, all of them good businesses, or at least having good businesses, good track records, and cheap valuations. Transaction Capital perhaps is the racier turnaround. Thanks, Lunga. Back.
Keith, thank you very much. Some surprised picks there, bravery call as well. So thank you very much for that coverage. You before I just jump into questions, you seem to have picked up there on Asanda on 40% earnings, but I did pick up that there seemed to be a subliminal rand hedge picks at play going on here. Hopefully, maybe some of the audience will pick up on that, gentleman, and take it up with you. So let's switch back to the questions. We haven't gotten that many. There are 2 questions. One question came from Justin Lewis. Thank you, Justin. Justin is asking, what does Astoria closing the discount look like? That's one question. Maybe let me just allow for that question to be tackled, and then I'll jump next to the other question pertaining the Lewis debtors.
Yeah, I don't think the investment case of Astoria is a closing of the discount. There will always be a discount to net asset value. You need to, from the net asset value, you need to deduct some sort of value on the management fees that get taken from the business. And there's probably also a discount for illiquidity, justifiable. But that's not the investment case, the closing of the discount. We think the net asset value will grow at a fairly high rate over the medium to long term. And if the discount remains where it is now, which is quite wide, and doesn't narrow, you will get that growth. Your investment will grow along with the growth in the net asset value. So we don't see the net asset value, we don't see the discount closing. It's probably too wide now. It should close somewhat, but under current circumstances, with all the negativity around, it's highly unlikely that it will close. The investment case is more that you are buying into some really good businesses with good management teams that generate cash, and you will ride along with the growth in those businesses.
Thank you very much, Pete, for covering that for Justin. The next question is from Joshua Filion. Joshua is asking, what are the thoughts on Lewis Debtors book going forward with the suppressed consumer? And regarding Lewis buying back shares, is there sufficient free float for this to continue in the future? Joshua is questioning also just liquidity there, touching on the sufficiency of the free float.
Well, it seems to be, I'll take the second part of the question first. There does seem to be sufficient liquidity that just came out of the SENS announcement, I think yesterday, indicating they bought back another 5%, almost 5% of the business over the past month, just in May of this year. So they are getting the liquidity. They are getting the opportunity to buy back these shares, and the company is shrinking itself. And yes, it might become illiquid, but if you own a business, liquidity shouldn't be top of mind. If you're a long-term investor and you stay the course here, if they buy back all the shares and you're just left with the shares that you own in Lewis, then you own the whole business. I mean, that's a fantastic outcome. So they're finding liquidity, and it's a great thing to be doing, to be buying back your shares at less than half net asset value. It's a fantastic opportunity, and long may it last for shareholders in Lewis. The first part of the question is the creditors book, or debtors book for that matter. Look, when IFRS 9 came in, they had to value their financial assets, or put a fair value in the financial assets and the financial liabilities, and accountants had all these formulas. But the assumption they used for bad debts was very, very high. The assumptions the accountants used in their calculation of the fair value of this financial asset. And in the 7 years after IFRS 9, the accounting standard came in, Lewis management consistently managed to have less bad debts in their book than the accountants assumed each and every year. And that's why their cash earnings are so much higher than their accounting earnings. And that continues today. The last results, they came in better, and they are expecting to improve it even further. Remember, in the industry in which Lewis operates, they have been doing this for many, many, many years. This is not the first time that they are lending money to clients against the security of the furniture. I mean, they've been doing this for decades. They're very well experienced. They know what the default rates are. They know what the non-payment rates are, and they price accordingly. And then they manage the book better than their assumptions. So I'm not too worried about it. If there is a hiccup, it's a cyclical thing, and it comes right again. Because deciding on your investment of stock based on current conditions is always a difficult thing. I'm not a big economic forecaster. I don't like forecasting, but I'll make an economic forecast. I'll make two. The first one I'll make is when things are going really well. My economic forecasts are always that they will deteriorate at some point in the future. My second economic forecast, which I think pertains to the current situation, is when things are going really badly, in a few years' time, it'll probably go better. So my economic forecast is for better conditions in the future than we are experiencing currently. And that's all I need to know when I look at these sort of stocks.
Thank you very much, Pierre, for covering those two questions. We have one for you, Keith. Looks like you stay the honest nest there. The question from Ronesh saying, I'm still perplexed with how the number of analysts continue to punt transaction capital. What is the time period do you give transaction capital to recover on the share price?
That is a good question. The first thing is I'm absolutely acknowledging that the environment changed, SA Taxi changed, and that valuation changed. And therefore, management had to make difficult decisions, and it is what it is on that side. Remember, my investment case gives SA Taxi zero value. One hopes that's wrong because 60 to 70 people in South Africa get to work and back to home afterwards by traveling in taxis. So, and the major funder in that market is effectively SA Taxi. So as a South African, I hope SA Taxi does not go under, but I give it zero value because I'm uncertain about some very large variables there and how they play out. So really, what is the investment case and why is it a punt? And how long will it take to play out? So you've got to make sure and have comfort that SA Taxi is ring-fenced. And management, you can go back, you can listen to interviews, results presentations, you can go and hear them answer questions, you can go and dig through things, and you could see they've consistently and repeatedly communicated, unpacked the structure there that it is ring-fenced. So giving it zero value, even if it does arrive at zero value, it won't come back to the rest of the businesses. So we can value the rest of the businesses almost separately and put them back together. And that's where Newton and WeBuyGars have attractive value. If I'm half wrong, the share price is still cheap. At 7 Rand a share, I think what has really happened is the market was in love with the stock over many, many years. And I can't remember, I think it was Templeton who said, beware of fast-growing financials. And this is a good example of that. It unwound very, very quickly. And therefore, the sentiment went from the sweetest of market darlings to the sourest mood. And in that lies the market inefficiency in pricing the rest of the businesses incorrectly as it's doing now. How long will it take to crystallize that value? Anyone's guess. In my personal experience, it takes 3 reporting periods, put out 3 sets of clean, good numbers, and the market starts to pay attention to you again, and serious people start looking. We have no idea in this case, but if the business stays this cheap and they do the way they're guiding, irrespective of SA Taxi, well, there's a lot of capital out there incentivized to make sure that value gets crystallized, be it in the listed market or the unlisted market.
Thank you very much, Simon. I'm going to just shift to you with these 2 other questions here, which I think are directed at you. So the first one concerns Caldro. What are the risks associated with land grabs and/or illegal occupants? That's the first one. The second one that comes from Sophocles. The second one is much shorter. Mashule is asking that haven't heard anyone betting on renewable or energy stocks and the opportunities there. I know that you touched on a play that leverages the transmission opportunities associated there. So those two questions over to you, Simon.
Yeah, so the first question is a real one, land grabs, and certainly Cargro's had problems with this before. They've also, frankly, had problems with infrastructure and just the ability to get a transformer, those giant big electrical boxes down the road to power. They've got smarter around that in the sense that they now make sure that they've got those agreements solidly in place. And the land grab issue really is around working with communities and engaging with communities. It is always going to be a risk in that space. They haven't had anything in a number of years at this point, but certainly I think that is something which investors are well worth giving consideration to. And I've chatted with Vikas Lautergan over the years, CEO, and asked him about it. And he said, you get smarter with it. He says you can sort of see it coming, you can try and head it off, but at the end of the day, it does remain a risk, and you can literally wake up on a Monday morning, go to site or go to a complex and find land grabs happening there. In terms of the second question around the renewable and the cabling, I mean, it's one of those things. I mean, in an ideal world, that business in time will start to actually fade away. But right now, there certainly is demand there. And there are other stocks who've got it. I mean, Mustech has got a bunch coming in that space as well. Solar panels, batteries, inverters, and all of those as well. They certainly benefiting from that. And even some of the retailers who just sort of selling hand over fist. I mean, most retailers you walk into these days have got some sort of power solution, everything from Incredible Connection. My local ShopRite even has the sort of battery torches and all of those sort of things that are coming through. So that certainly is, it's kind of been forced onto us as a country. But truthfully, the shift to renewable was going to happen. If you see what's happening in Western Europe, in Scandinavia, in Australia, it is just one of the large trends of our generation.
Thank you very much. I'm going to circle back yet just to you. I think there is one more question. You've partially addressed it, but probably this one is asked differently. One is from Mkhululi. Mkhululi would like to know, how is it that the outlook for two businesses in the same sector, one in vehicles, the other or transport, that is the taxi, says the other one second-hand cars, so different?
Yeah, so I think you've heard into VCG, which is one of the companies in Astoria, which, amongst other things, finances second-hand car vehicles. So the difference between VCG and SA Taxi is, first of all, VCG is a lot smaller. It doesn't dominate the market, and it is not growing as fast. It's growing at a much lower rate than Transaction Capital used to grow at. It is very cautious in how it lends and against what security it lends, and it's also very cautious about the collateral, the value of the collateral. So it's a young business. It's only about 4 years old. It was started about a year before lockdown. It went through lockdown with no bad debts, and it has continued on that trajectory since then, cautiously growing into a market using very conservative assumptions. So that's why it is so different, because it's much smaller, much younger, and I guess much more cautious. When you are in a listed environment and your share price is trading at a multiple of 30 times, there's huge pressure on management to come up with big numbers. And in that process, sometimes management lets down their guard with respect to collateral, with respect to the type and amount of credit they grant, just to make the number, because that's what the market wants at a very high multiple. And I think that is sort of trap that Transaction Capital fell into at one time. Whereas VCG is a privately owned business, it's not in the headlights. Management is under no illusion that their job is to grow the business responsibly and not try and satisfy the market's requirement for 30% or 40% growth each and every year. So that's why it's very different.
Thank you very much. Yet before you mute your mic, it looks like you're taking more questions here. I'll be coming to you Asanda shortly. I think then we will be almost wrapping up. On Astoria again, Sophocles would like to know what is the exit strategy for the underlying investment and who currently values those companies to calculate the current discount to NAV.
Yeah, so those are two very good questions. The first question is, what is the exit strategy? There is no exit strategy. We will own these businesses for a long time, hopefully. We hope to own them for a very long time. Of course, if somebody comes along and wants to buy one of them from us, they will have to pay a very high price to acquire that business. But we have no exit strategy. Remember the difference between Astoria, which invests in private businesses, and a private equity company. A private equity company normally has a 10-year investment period. So after 10 years, they need to liquidate the fund and give the money back to the investors. So, and 10 years is not really a very long time to get in and out of a private business. Astoria is a closed-end investment company that will carry on for a very long time and has no end point. So we don't have to sell at some point and return the share and return the cash to shareholders. We can sit there and collect the dividends over time that these businesses generate and reinvest them in acquiring more shares of the same businesses or acquiring a new business. That is our choice, and that is our strategy going forward. So no exit strategy. And in terms of valuations, who values the business? Well, we value the business. The directors of the company value the business in conjunction with the auditors, because as I pointed out earlier, auditors these days under IFRS play a very important role in valuing assets. And we have lots of debates with the auditors. Generally, our valuations come in well below what the auditors is. The auditors want us to have higher valuations, and we come in below the auditors' numbers, generally speaking. But there's a very robust debate between ourselves and the auditors about the fair value of businesses. And, we also look at what similar businesses are valued at the market, and, we value it conservatively. We want, if there are surprises, we want the surprises to be positive, not negative. So that's our strategy in terms of valuing the businesses.
Yeah. Thanks, Pierre. Gentlemen, that kind of brings us to a close, but I would like you just to give you one each 30 seconds quick take on the things that you like to highlight. Asanda, I'll start with you. I know there were no questions fielded directly to you, but there may be things that our audience may be missing for the reasons why you picked some. If you could just give one or two, then I will move over to you, Simon, and take you, Keith. If there is anything you'd like to add, happy to wrap up with you. But if you feel you're comfortable, you've covered all the angles, happy to wrap up immediately shortly after.
Well, thanks. And thank you again for the time. So I think hopefully the story was clear, or the stories were clear, but maybe just wanting to highlight, in terms of the way that we go about investing, I think as you said, Langa, earlier, we do focus on what the businesses do, the sustainability thereof, looking at who's managing those businesses, because it's possible to have a very, very good business on paper, but poorly managed won't actually be able to realize the potential that you see in the company. So I think that's an important aspect, maybe just to highlight for anyone who's investing. And I think also what's important is, I think in all the discussions we've had, is to take a relatively longer term view, especially in investing in sort of shares, where we're all making assumptions about what's going to happen in the future. And so you do want to maybe take a longer term view around your investment horizon. But to thank everybody who's come on, and the fellow panelists, and thanks, Langa.
Thank you. Simon, any 30 seconds closing thoughts?
So I actually want to sort of expand on what Pete said a moment ago, where when things are bright, typically they get better. I mean, most of my best investments have been made, in the early 90s when everyone in South Africa was terrified. 98, the world was going to end, emerging market crisis, 2008. And I'll give you one quick example. Load shedding is going to end. Let's be clear. not because Eskom's going to get power stations working, but because everyone's going to put solar on their houses. The mines are going to put solar. We will get independent power and load shedding will end. And pause a moment and think what happens when load shedding ends. Those billions and billions of rands that are currently being spent on diesel and generators by our retailers and everyone else from the JSE, that money will just flow straight back into the bottom line and comes through as profits. So what I'm saying is, just because it's dark out there, literally, and so times in load shedding and gloomy, it's not the end of the world. Things are cyclical, things will come and go, and our stock market will rally again. To the question of when, that I don't know, but I do know that when it's gloomy, people sell things that they often regret selling in time, and I like to be a buyer at that point.
Yeah, thank you very much. Keith, I'll give you literally 2 seconds. Our sponsors are knocking at the door. And Pierre, if you don't mind, I will skip you, then I'll wrap up. Thank you very much.
Langa, then I'll keep it very, very short. Thanks, everyone. I think the panelists have all been excellent. Langa, you've been a wonderful host, and appreciate the audience. Thanks very much, everyone.
Thank you very much. Thanks, Keith, Simon, Asanda, Pierre, for a wonderful picks and coverage of the gems. Thank you to everyone who joined us today online. The JSE remains the leading stock exchange in South Africa and Africa. We have deep liquid markets. Any of these shares discussed today are available trading at the JSE. So please do knock on the door of your stockbroker and ask them about them. The important disclaimer, the panelists have spoken here are independent panelists. The views they've expressed are their own, not sponsored or promoted by the JSE. The JSE is a licensed stock exchange and the market structure operator here in South Africa. We thank you very much. Thank you, gentlemen, for your time, and thank you everyone who joined us online, and goodbye.